Okay. I think you already kind of touched on this, even spanning the last decade. There were a number of years where the markets maybe went down. And if we go back even further in history, so I think, correct me if I'm wrong, but probably from about 1999, 2000 until maybe 2010, 2011, even, there was probably not much. If you had started investing in 2000 at the peak, you probably didn't make any money for 12 years, right? So I guess you go through stretches where maybe the markets aren't making anything. So is it safe to say that you're trying to smoothen the ride during those turbulent times?
Exactly. So the reason for holding alternatives in your portfolio, aside from the big picture reasons to have it as an asset class that just has worked for a long time, is it is there for two major reasons, which are sort of opposites of each other. So the first one you've touched on is that they're there so that in those periods of volatility or longer periods where markets, are flat or don't do that much, they are there to offer returns to people. So, we all know that until recently, obviously yields have gone up now, but you were hard pressed to find returns from the bond market for many years, at least in terms of coupons. There were capital gains to be made, but for those seeking income only, it was pretty tough. So, in periods of time where markets go down or are flat, yes, you have a proven track record of these assets producing very, very solid returns. It's not just even in broader markets. I've been in the business for long enough that I've come across, I don't know how many exactly, but I've come across a number of people who I meet and they have an entire portfolio of bank stocks. And of course, they say, "Well, these are great companies," and they are. They're great companies. No one would doubt that for a second. But even bank stocks have 5, 6 year periods where they don't appreciate and they make their dividend payments, but the return is not fantastic from a capital appreciation perspective. Um, a way to make money in those time periods. The opposite of that is that when markets do go down and do fall and do have double digit negative periods, it gives you an opportunity to alter your asset allocation and take those assets, which have hopefully produced positive returns, and now potentially alter your strategy and use those funds to take advantage of those falling and lower markets, not to sell something that is in a losing position for to buy something else that is in a losing position.
Got it. Now, some people may challenge the notion of liquid alts by saying, well, instead of investing in a liquid alt, why don't I invest in a so called true alt, like directly into cell phone towers or farmland? Because investing in these true alternatives allows me to benefit from the so called illiquidity premium. I've talked to people, and this is what they tell me. So I want to pose this to you. How do you react to that?
I react to that actually in a very similar way to people who have come to me for the last 20 years and say, well, real estate is the way to make money. Why would I buy X or Y? And my answer is, why not have a little bit of everything? You want to buy the cell phone tower and the farmland as a piece of your wealth? Go ahead. You should. But so I'm not a proponent that the only thing in the world people should have in their portfolio is what I offer. Um, we luckily do deal mostly with people who have an ability to, obtain a growing wealth profile or who already have obtained it. And I'll be the first one to tell you that if someone has the room in their portfolio for those types of assets, they should absolutely own them as a piece of their portfolio. So I'm not the advisor, and my partner is not the advisor who tries to push people away from good ideas. We say, yeah, you should have all good ideas in your portfolio. We just think you should limit them to a certain percentage, like anything in life.
Yeah, fair enough. Can you speak to returns of some of these liquid alts and compare them to returns of the TSX and the S&P 500, just kind of broadly speaking, over the last 10, 12 years?
So there is no, say, liquid alternative index per se. There are some hedge fund indexes, but those do really include such a wide array of assets that they're not a true comparison. So, I look at our strategy, and the good news is we've actually done this. So we created basically a list of most of the alternatives that we use or have used, and we've benchmarked it against a typical Canadian investor's portfolio. Now, the difference with ours is that, yes, we've put together a 60/40 model, but it's not just a 60/40 model of stocks and bonds. The equity portfolio is made up of Canadian, US, and international names, and the fixed income portion is made up of different types of bonds, preferred shares, and cash. We did that because we believe that that gives a more accurate picture of what the average Canadian investor's portfolio looks like. Very rarely do I meet a person with a portfolio who has fixed income of nothing but bonds. We see a lot of preferred shares, GICs, cash, so a little more appropriate to do it that way. Generally speaking, over the last 10 years, we looked at the alternative platform and against some of the more well-known benchmarks in North America, especially the TSX. The returns are significant. I can go into the details of what those numbers are, but I'll say it's middle single digits in terms of the per annual annum difference in a positive manner. Imagine making single digit returns over and above what you're making every year for the last 10 years. I will say the S&P would have produced a better outcome against our alternative platform for the last 10 years. And that's obviously, the S&P has performed significantly better than the TSX for the last 10 years. It's not a surprise. The only thing we do tend to warn clients about, when using that example, is probably the idea that we're going through right now is the opposite side of that coin, which is the S&P for 10 years did do quite well. However, a lot of the reasons for that were on the backs of a very small number of thinly based lack of breadth. It was about 10 to 15 well-known companies on the tech side that carried the index. And now I think this year we're starting to see the other side of
Perfect.
that.
This segues nicely into my next question. So I'm going to challenge myself from earlier in the talk, and I'll try and gently challenge what you just said. This is just for thorough discussion. But I guess the reason we try to index, so a lot of people, myself included, we invest in index funds. And so the reason we index is that we know, generally speaking, there are going to be maybe a handful of companies that are probably going to carry the market. That's what's been happening for the last 10 years or so. And it's really hard to go out and pick those companies individually. And now the dynamic has shifted and there may be a new batch of companies. I know I myself, I'm not going to be able to pick them. So I choose to index. And I know that I said from 2000 till at least just past 2010, if you invested at the peak, you indexed, you probably didn't really make any money. But then when I go back in time and I look at rolling 10-year periods from 1937 to now, about 85 to 90% of those 10-year stretches are in the positives if you invest in the index. So I guess why should
Yeah, of course. And it's a common theme that we hear all the time. And I guess there's two answers. There's the short one and the slightly longer than short one. So yeah, yeah. The shorter answer is very similar to what I just mentioned previously when you asked me what do we tell people who, say they like cell phone towers and farmland. And the first and shorter answer is you can it's not a black and white. It's a gray. You can have both. You can and should do both. We don't tell people alternatives should be 100% of their portfolio. Uh, the largest pension funds that we know in the world don't have 100% of their portfolio in alternatives. So understanding that, you can totally have elements of S&P or MSCI World Index or TSX in your portfolio as long as there's an understanding that when markets do go down or are flat, that is the part of your portfolio which you can count on the least to protect you. So The way we look at it, and this sort of segues into the longer answer, and I guess for you and your audience, I'll maybe use an analogy which isn't perfect, but hopefully it makes sense. You have a patient and you can say, okay, this person has been my patient for 40 years. And generally for the last 40 years, that's a healthy person. She is a healthy person, and they're doing well. But over that 40-year period, they still got sick, they still got really sick, they still had health problems. um, the question you would ask yourself is, if I could eliminate those periods of that person's life where they were sick or not well, would I? And the answer is, of course, you would. So it's the same thing in my business. Um, Index returns will produce generally healthy results over long periods of time. But what we're here to do is to say, in all of those periods when markets do fall, and I just named about six of them in the last 20 years, so they come along very often. We're here to sort of say, okay, when that's happening, let's try to prevent the sickness. Let's try to keep you healthy in those bad years. And so what that looks like in portfolio terms is, in the periods where you're making money and the markets are doing well, you're building profit on profit, and the returns become way larger and way more exacerbated than just index returns. And as you know, it doesn't take a large number above index returns to produce a significant amount of wealth, especially when you're compounding later in life. Even 3 or 4% over 40 years is a massive difference maker. So we're not here to, we're not proponents of never owning index style investing, but rather to, uh, you know, take those periods of time when things don't go well and give you a chance to spend the least amount of time or very little time being, so to speak, ill or sick. Let's be healthy the whole time, not just
But I
at the
suppose there will
beginning.
come a time when maybe you may decide to pivot a little bit more aggressively to equities. This may or may not be true, but let's say you do change your posture, your stance a little bit. I guess the decision as to when to do that, doesn't that involve some element of market timing, which we know that over the course of history, and we know that the more we try and do it, and over the longer term, this becomes harder and harder to do. Like, isn't there an element of market timing as to figuring out what posture you're going to take? Talk to us about that.
Yeah, and that's a good point, and I would expect that to be an argument that or that someone would make, and it's a valid point. I think where we want to be clear is, we're not going from very little to a lot or a lot to a little, because alternatives, in our opinion, based on the way we feel about them over long periods of time, should always be a fairly decent component of your portfolio. So when we're talking about shifts in market sentiment, I'm not taking alternatives, down from 50% to 5. I might be, over the course of an entire market cycle, maybe taking it from 20 up to 35 or 40 per se. And that means a shift in equity from, like I said, 20 or 25% upwards or downwards. I can do that and still produce really, really good returns for clients, because the alternatives are not there to only do well when markets are bad. They also do extremely well when markets are good. And even in some good years, they do beat the market. So as long as they do well in good markets, that's more of an assumption. When the markets are bad, if they're also doing well, and I want to shift back to equity, I don't have to go from 0 to 60 in 5 seconds. So it's not as big as a shift as one may seem. It's more of a shift from a regular weighting to in alts to a larger one back to a regular one.
Okay. You mentioned pension plans, and a lot of us also like to keep an eye on major pension plans and how they're investing. So, currently, what is the status of pension plans and their focus on liquid alternatives or alternatives
Yeah.
in general?
Yeah, that's a good question, and I think it's something that people should be paying more attention to, because at the end of the day, even though pension funds still have their blips and errors, they are the, so to speak, the best money managers in the world. And the history and the facts prove that. And so, years ago, they had very little to none. But if you look at, small, medium sized, large pension funds, endowment funds, you're looking right now, depending on what type of pension fund, large pension funds are holding, around 35% of their portfolio in alts. Small pension funds are over 40. And then you have some medium-sized ones, that are in the 25 to 28% range. Some endowment funds, even in the United States, that are very well known, have gone as high as 70 to 75. So the way we look at it, and one of the mantras we speak to at every new meeting with a new potential client is, now that you have the ability to invest like a pension fund, why wouldn't we do this? Why wouldn't you want to have the same strategy as the best money managers in the world that have proven time and again to have been able to withstand market volatility better than any regular investor? So that's why we sort of start with a 20 to 25% weighting, because that's typically the lowest weighting you see from a pension fund today.